Comments made on the following paid commercial program are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time.
Welcome to the Money and Wealth Show. On the program this week, tax tips with David Ingram, money commercials, and our special guest, Chief Investment Strategist at Institutional Advisors, Bob Hoye. Welcome to the Money and Wealth Show. I'm Sterling Fox, and it's a pleasure to welcome back to the program the editor and chief investment strategist for Institutional Advisors. Bob Hoye is back with us. Nice to see you, Mr. Hoye.
Good to be back here.
You're back with us. Now, Bob was one of our very first guests back in the early part of this year. You made some very interesting predictions at that time, but before we get to that, you've just returned from a recent trip to Japan. You were there just a few days in advance of the APEC Summit with some of your client groups over there. What's the feeling in Japan these days vis-a-vis global economy? They're still having a pretty quiet time.
Oh yeah, they know that their government spent too much money. They know that they can't get it to stop, and they're just looking to survive on their own. Anybody I met in the investment business is not relying on government. They're doing it on their own. So, but other than that, Japan is a lovely place to visit and travel in.
Now, Bob, we're on the last Saturday of November. It's the time that all the predictions start rolling out for the year ahead. But before we get to that, let's take a look at 2010, a month away from the end of the calendar year, and what kind of year it's been, particularly through the lens of your predictions for 2010.
Well, this is good time to review it because it was a year ago now that when our research started looking into what would happen in the junior gold exploration stocks. And we have a background there of the real price of gold advancing, which represents profit margins. And it had been advancing for quite some time, and we thought that it would pull the junior golds up that had been dead. Sure, you had that gold junior exploration index, but they had been selected and were doing very well. So this was the pack of them that weren't there. And we thought that that market would widen as more and more of the juniors started to participate in the game. And we thought it would widen with more investors and traders coming into the game. And it turned out to be a very good market. Indeed, as up until recently, there's been a lot of excitement there. So that was one of the main things we were looking for. The other thing we were looking for is the probability that the rally coming out of the first part of the year in the stock market would peak in the spring, then do a fair-sized correction, and that happened as well. And then actually, more recently here, we've been looking for a peak in the speculation in the commodities, along with gold and silver. So that's the general wrap on that, Sterling.
Well, now, as we spoke earlier in the year, late February, early March, that rally in the stock market was well underway, and there was a sort of buoyant feeling among investors the world over, especially here in North America. Now here we are at the end of November, Bob, and I don't get that same energy hit from the investment community now vis-a-vis especially North American stock markets.
Yeah, there was good action, but more so in commodities, like the grains had a bad season around the world.
Yes.
So there was tight harvests, and there was tremendous action there, all, of course, factored against the falling U.S. dollar. And what we had conspiring against that for this falling U.S. dollar was that the good was coming as everybody saw the Republican gains in Washington politics. That was a plus for the markets. That also lined up with Bernanke at the Federal Reserve renewing his vows to depreciate the dollar, this time more seriously than he's ever done before. So that then was coming into the market. And then the final one was that Group 20, the G20 meeting, and that was considered to be a plus. So what happened was that all of that was in the markets. You had buoyant stocks, really roaring up commodities, very good action in gold and silver. And then bang, after the G20, well, we realized that they hadn't solved the problem.
All right, now Bob, if there has been buoyancy and activity in commodities, in equities, in precious metals, as we look back at 2010, and I know we're still technically a month away from the year end, but it is the last Saturday of November, is it safe and reasonable to say that the one sector of the economy that has taken the biggest hit has been bonds?
The long Treasury bond has taken a noticeable decline, and it's approaching support, but it may not hook. There's a lot of bonds that the Treasury is issuing. There's never going to be a crop failure in the issuance of U.S. Treasuries. But on the other side of that, Sterling, is you've had very speculative move in the corporate bonds. And it seems that the more risky the bond, the more it's been bought, such as the junk bonds. It's had a fabulous year for corporate bond prices. And as those prices went up, the yields came down, and then the spreads relative to treasuries narrowed. And that's always a sign of a great party. So we weren't getting any technical signals on the long corporates, but let's just say it's getting pretty a popular move, and there is considerable risk in there. Some of the other risk products we look at, like the money market stuff, the short end, anything shorter than a year, there's been a little widening of spreads there. But the big telltale in the market is, as you pointed out, the workover that the long Treasury market's been getting, and that has steepened the curve. By that we mean the difference between 3-month Treasury bills or 2-year notes and longer stuff like the 10, 20, and 30-year stuff. And that was a change in the credit markets to steepening. And we should recall that in May and June of 2007, you had that reversal in the credit markets to steepening the curve and the reversal to widening of credit spreads. So at this point, we see steepening. But the widening of credit spreads has been a little...
Still eluding us,
not yet,
isn't it? Yeah.
not yet. But if it comes in, it'll be another signal that perhaps there's another credit concern coming into the marketplace.
Our guest this week on the Money and Wealth Show is the Chief Investment Strategist for Institutional Advisors. It's a real pleasure to have Bob Hoye back with us. There's lots more ahead, too. Stay with us.
Hi, I'm Larry Ray, President and CEO of American Manganese, Inc.